So let me say something about this. This is just an incredibly interesting thing. It doesn't sound interesting, does it? Federal Open Market Committee report of ad hoc subcommittee on the government securities market, November 12th, 1952. Okay, so the date is interesting. It's a long time ago. And it turns out there's some preamble there that says that this was a secret document that was internal inside the Fed and only came to light when there was this congressional investigation. And what this document is the Fed's own internal judgment about how they're going to be running monetary policy from 1952 on. Okay, and it's incredible, partly because it's quite similar to some of these money view ideas that we've had, and not very similar to what showed up in the academic textbooks, which were written before this document became public. What the academic textbooks picked up was the sort of public version of this, okay, which isn't exactly what they themselves thought they were doing. So let me just give you two passages here. This is from the preamble, page 2007 here. We're only going to read part of this, and I'll send you some pages so that you don't have to read the whole thing, because a lot of it's technical. But they say here, it's important that the technical operating procedures and practices conceived in the atmosphere of war finance and developed to maintain a fixed pattern of prices and yields in the government securities market be reviewed to ascertain whether or not they tend to inhibit or paralyze the development of real depth, breadth, and resiliency in today's market that operates without continuous support. Okay, that's a long sentence. What they're saying there is during the war finance, okay, the Fed pegged Treasury rates. It said the Treasury bill rate, I don't have it here, but let's say it was 1%, okay? And if it deviates from that, if it tends to go up, we're buyers. And it pegged the 10-year rate. Let's say it's 2%. And said, and if it deviates from that, we're buyers. So there was continuous support for the market. The Fed was not the dealer of last resort. It was the dealer of first resort. It was actually issuing these bonds in a sense and was the underwriter. It was saying, we're gonna hold these prices here for the duration of the war. And not only that, after the war. So when the war was over, bondholders were assured that the Fed would continue that so that they wouldn't have to take capital losses. Because of course, if the yields on the long-term bonds rose, you would take a capital loss. The price would fall. So the Fed maintained that fixed price. Eventually, it got its own authority back, okay, in the famous Fed Treasury Accord, when it was allowed to move short-term interest rates. It was allowed to get some authority over moving short-term interest rates, and that's the birth of monetary policy after the war. And this is the document in which the Fed explains what they intend to do with that new authority, okay? That's what this is all about. And it's secret, okay? That's one thing. They talk about this government securities market. By 1952, there has been a development of a dealer market in government securities, where there are dealers buying and selling. They talk about arbitrage on the yield curve. They talk about this business about depth, breadth, and resiliency. They're talking about liquidity, okay? Market liquidity. They're saying that the government securities market is now sufficiently liquid through the involvement of private dealers. Private profit-driven dealers that the Fed no longer needs to support prices in the way that it was doing. It will continue intervening, but around the edges and to try to influence the shape of the yield curve and so forth. So they're very explicitly talking about a world in which there are Treasury securities of various maturities. Okay. During the war, the Fed was pegging the 1 year, the 10-year, and all the different maturities. Okay. After the war, it's dealers, it's private security dealers, and they're making markets and in between, in all of the different ranges in between. And they're doing arbitrage, okay, between all of these, using arbitrage like using notions like the forward interest parity and things like that. So the Fed is saying that it is going to continue to intervene in the money market in order to maintain the tone of the money market. It understands that dealers are financing their holdings of long-term bonds by borrowing in the money market. Okay, so that these are leveraged dealers. They understand all this, and it's 1952. You know, this is a very advanced document, a very advanced understanding of how modern securities markets would work. Just for governments, there's almost there's no discussion here of bond markets or stock markets or anything like that. You know, this stuff was still on its back. You know, after they all closed down during the Depression and the war. It's all about governments, okay, at this moment. And how do they think they're going to influence? They talk here, their understanding of open market operations is quite fascinating. They say it's a very different way of intervening than changing the rate of interest. Okay? In any modern macroeconomics textbook, you will hear that these are equivalent. Changing the rate of interest and open market operations are equivalent. They don't think so. They're not thinking of those. They say any purchase or sale of government securities by the committee, so that's open market operations, any purchase or sale of government securities by the committee, the Federal Open Market Committee, adds to or subtracts from the reserves of the member banks and is promptly reflected in the tone of the money market. A relatively small injection of funds through the purchase of bills will ordinarily find a response in the market for long-term securities. Large purchases of bills could scarcely fail to elicit such a response. Okay, so they're talking, this reminds me of, remember those diagrams we had when I was talking about the transmission of monetary policy, okay, about how the Fed is operating in the overnight money market, okay, and that has consequences for the term funding markets, which has consequences for the long-term bond prices. That's exactly what they're saying there. They're saying that the purchase and sale of bills, so they're talking bills, treasury bills, are less than 1 year. Okay, and open market operations were going to be about buying and selling bills. So in this, that is going to affect this whole curve here. So they're talking about a transmission mechanism to asset prices. None of this story that you get in standard macroeconomics textbooks about how, well, you're going to change the interest rate and you're going to increase the reserves and then banks are going to lend that out and it's going to cause credit expansion. The first thing, the only thing they're talking about here is transmission along the yield curve to asset prices. That's it. And that's what I've been emphasizing in this course, that's how you should think of the money market. The money market is connected to the capital market, okay? And in a lot of ways, okay? And not just through the expectations hypothesis of the term structure. It's the fact that many of these dealers are highly leveraged, they're holding bonds and they're financing in the repo market, so like that. They're shadow banks, essentially, in the government securities market. So I find this a fascinating document. Have I gotten that clear by now?